Welcome to our next podcast episode. Today, we are delivering an executive analysis of Willem Tait's book, Raising Money for Real Estate Investment. Close deals, raise money, build wealth.
Thank you for having me. I'm looking forward to this discussion.
For those operating within the commercial or residential investment space, this analysis will demystify the complex financial engineering required to scale a real estate portfolio.
Indeed. We are moving past rudimentary concepts here to extract actionable corporate strategies for securing capital, structuring debt, and mitigating portfolio risk.
Right, but before we systematically unpack the financial models presented in his book, well, it is necessary to establish the author's professional context.
Absolutely. Willem Tait is a management consultant, enterprise strategist, and a retained advisory specialist. He is also a highly recognized coach and mentor in the corporate sector.
And he maintains a diverse portfolio of multiple books alongside his consulting practice, correct?
That is correct. For those interested in his broader methodologies, the most direct way to explore his professional advisory offerings, as well as his research papers on academia.edu, and his regular publications on medium.com and substack.com, is via the Linktree URL located in the bio of this podcast.
Precisely. Furthermore, his books are available worldwide through major retailers, including Amazon, Apple Books, Walmart, Barnes & Noble, Bol.com, Waterstones, and Exclusive Books.
However, we highly recommend a specific strategy for accessing his work today.
Yes, we explicitly direct you to email or message your local librarian today to formally request that this book be added to their digital portfolio.
This ensures that you and your wider community can read the work completely free of charge via mainstream library lending applications such as Overdrive, Libby, Hoopla, or Odilo.
Utilizing those digital library platforms is simply a highly efficient way to access the material.
It certainly is. Turning our attention to the core concepts Tait outlines in his book, the fundamental premise is that capital must be viewed not merely as a requirement for purchase,
but rather as a strategic mechanism.
Exactly. The precise structuring of your funding dictates the profitability, the risk profile, and the ultimate scalability of any real estate transaction.
We need to systematically unpack this, starting with the capital stack. Before an investor can execute a complex commercial acquisition, they really must master the interplay between the two primary tranches of capital,
which are, of course, equity and debt. The mathematical relationship between these two determines your operational resilience.
Let us define those clearly for our listeners. Equity represents the capital placed at the highest risk, does it not?
It does. It is the ownership stake, positioned at the absolute bottom of the capital stack. This means in the event of liquidation, equity holders are paid last.
But it provides a necessary stabilization for the asset.
Right, and it demonstrates to senior lenders that the sponsors have committed capital at risk. Debt, conversely, is the senior leverage. It is a contractual obligation backed by the asset itself.
The utilization of debt introduces the concept of leverage, which requires a precise mechanical understanding. Rather than using the common, somewhat flawed metaphor of debt being mere scaffolding, his writing reflects that it is more accurate to view leverage as a financial fulcrum.
That is an excellent way to frame it.
If you acquire a $5 million commercial asset using $1 million of equity and $4 million of senior debt, you are controlling a massive underlying asset with a 20% capital injection.
Precisely. And if that property's value increases by 10%, which is a $500,000 gain, your return on equity is not 10%, it is 50%. The lever exponentially amplifies the yield.
However, the lever applies equal force in the opposite direction.
It certainly does. If the market value compresses by 20%, your entire $1 million equity position is effectively wiped out.
Even though the asset itself only lost a fraction of its total value.
Exactly. Tait emphasizes in his book that managing this loan-to-value, or LTV, ratio is critical. Furthermore, investors must strictly monitor for negative leverage.
Negative leverage, right. That occurs when the cost of borrowing, the interest rate, exceeds the capitalization rate or yield of the property.
Indeed. When that inversion happens, every single dollar borrowed actively destroys equity value.
That mechanical reality forces a strategic decision. If you identify an asset with strong fundamentals, but you lack the necessary equity to maintain a conservative LTV and avoid negative leverage, how do you proceed?
Relying entirely on personal liquidity creates an immediate ceiling on portfolio growth.
So Tait's approach to solving this equity constraint involves the strategic deployment of syndication and joint ventures.
Yes. Rather than abandoning a viable acquisition, the sponsor restructures the equity tranche entirely.
In a syndication model, The general partner, who identifies and operates the asset, pools capital from multiple limited partners.
Right, and those limited partners provide the majority of the equity in exchange for a preferred return and a share of the subsequent profits, while assuming a strictly passive role.
But the limitation of that model is the regulatory complexity.
It is significant. Structuring a syndication requires strict adherence to securities laws, typically utilizing exemptions like Regulation D in the United States.
Because you are no longer just buying a building, you are legally issuing securities to investors.
Exactly. That is a necessary friction for institutional scaling. But for investors seeking a less complex legal structure, a joint venture provides a solid alternative.
A JV typically involves two active entities, correct?
Yes, perhaps an operating partner who manages the asset and a capital partner who funds the equity requirement.
Right.
Both models serve the same fundamental purpose.
Which is expanding the equity foundation collaboratively, safely supporting the required senior debt without over-leveraging the sponsor's personal balance sheet.
That is the core objective.
Moving up the capital stack, we must address the scenario where traditional senior lenders restrict capital.
A very pertinent topic. If a commercial bank's underwriting criteria becomes stringent due to macroeconomic tightening, the acquisition strategy does not necessarily fail.
Right. In his book, Tait outlines an extensive matrix of alternative funding mechanisms. Alternative capital has fundamentally restructured the modern real estate market.
It really has. The capital stack is no longer limited to a simple binary of bank debt and owner equity. When a gap exists between the maximum allowable senior loan and the available equity, Tait details mechanics of mezzanine financing.
Now, I want to clarify the structural mechanics of mezzanine debt because it is frequently misunderstood by emerging sponsors. It is not a secondary mortgage.
No, it is not. The senior lender typically prohibits any subordinate liens on the physical property itself.
Therefore, how is a mezzanine loan collateralized?
That is a critical distinction to make. A mezzanine lender secures their capital not with a lien on the real property, but through a uniform commercial code, or UCC, pledge of the equity shares in the limited liability company that owns the property.
So if the sponsor defaults, the mezzanine lender does not foreclose on the building.
Precisely. They execute a rapid UCC foreclosure to seize the ownership of the LLC itself.
Because this debt is subordinate to the senior lender and carries higher risk, it commands a significantly higher interest rate, I presume.
It does, but it prevents the sponsor from having to dilute their equity by bringing in another permanent partner. It acts as a highly effective bridge.
Beyond specialized institutional debt, his writing reflects on the digitization of capital formation, specifically examining crowdfunding and tokenized real estate.
Yes, those platforms have democratized access to capital. Crowdfunding platforms allow sponsors to aggregate capital from hundreds of unaccredited or accredited investors simultaneously.
However, I find the application of blockchain tokenization in real property highly theoretical at this stage.
How so?
Well, does acquiring a fractional digital token offer any tangible security, or are investors simply buying an unsecured position in a volatile digital ledger?
Yeah.
It seems functionally similar to buying a single pixel of a high-resolution image.
Your skepticism regarding regulatory enforcement is warranted, and Tait addresses these exact limitations in his book. However, the architecture is far more robust than a simple digital image.
I am interested to hear how he justifies it.
Tokenization utilizes smart contracts on a blockchain. These contracts are programmed to automatically execute the distribution of net operating income to the token holders as dividend payments.
So the token represents a legally binding economic interest in the asset's cash flow.
Precisely. While the regulatory framework is still maturing, the primary utility of tokenization is the creation of secondary market liquidity.
Right, because historically, limited partnership shares in commercial real estate were highly illiquid.
Exactly. Tokenization theoretically allows an investor to trade their fractional ownership instantly on a digital exchange, removing that illiquidity premium.
That is fascinating. But whether capital is sourced through a decentralized blockchain exchange, a mezzanine fund, or a traditional syndication network, the acquisition of that capital requires rigorous defense of the underlying financial models.
Without a doubt. In this book, Tait transitions from the theoretical structures to the execution of the investment proposal. Securing capital is entirely contingent upon a highly detailed pro forma.
The pro forma is essentially the quantitative foundation of your pitch.
It is. It is an extensive, forward-looking financial projection detailing the income statement, cash flow statement, and balance sheet over a specified holding period, typically 5 to 10 years.
However, a pro forma is ultimately a document constructed on assumptions.
It is. Any analyst can manipulate spreadsheet variables to show an attractive internal rate of return.
Right. Lenders and sophisticated limited partners do not simply look at the projected cash flow. They aggressively stress test the underlying assumptions.
They absolutely do. They scrutinize the debt service coverage ratio, or DSCR, to ensure the net operating income can comfortably service the debt obligations, even if vacancy rates spike unexpectedly.
The burden of proof lies entirely with the sponsor. Tait outlines that a comprehensive feasibility study must accompany the pro forma.
Yes, if your model assumes a 5% annual rent growth, your feasibility study must provide the demographic data, employment trends, and supply-side constraints in that specific submarket to justify that projection.
The proposal is essentially an exercise in risk mitigation.
It is. You are demonstrating to the investor that you have calculated the operational expenses, the capital reserves, and the terminal capitalization rate at the projected point of sale.
That rigorous analysis establishes initial trust. But capital management is a continuous requirement. In the back matter of the book, you will find extensive frameworks for investor relations and crisis management.
Which is paramount. The integrity of a sponsor is rarely tested when a project delivers its projected yield.
Right. The real test occurs when a project encounters severe headwinds. For example, supply chain disruptions that trigger massive construction delays.
Or a scenario forcing a capital call where investors must inject additional funds just to save the asset.
Tait establishes strict protocols for these scenarios, does he not?
He does. The standard operating procedure for conflict resolution involves immediate transparency. Delaying the communication of negative variances in the pro forma destroys institutional trust completely.
So the sponsor must formally acknowledge the issue immediately.
Acknowledge the issue, present a quantitative analysis of the impact on the overall yield, and immediately provide an actionable, revised strategic path forward.
Navigating an operational crisis with professional transparency frequently solidifies investor loyalty far more effectively than a project executed without any friction.
I agree completely. It demonstrates executive competence under pressure.
Once a sponsor demonstrates the ability to execute acquisitions, navigate debt structures, and maintain investor relations through market volatility, the strategic objective naturally shifts towards scaling the portfolio.
Indeed. We must examine the mechanics of transitioning from residential or small multifamily assets into large-scale commercial real estate.
Scaling is not merely the process of acquiring more units. It is the process of decoupling the sponsor's time from the revenue generation.
That is the ultimate goal. In his book, Tait highlights the efficiency of commercial triple net, or NNN, leases to achieve this.
The structural advantage of an NNN lease is how it reapportions operational risk. In a standard gross lease, the landlord absorbs the volatility of operating expenses.
But in a triple net lease, typically utilized with credit-grade corporate tenants, the tenant contractually agrees to pay the base rent. Plus, they assume direct financial responsibility for the property taxes, the building insurance, and the structural maintenance.
By transferring that operational and inflationary risk to the tenant, the sponsor secures a highly predictable, stabilized yield.
It functions very similarly to a corporate bond. This predictability is highly attractive to institutional capital and allows the sponsor to manage a significantly larger portfolio without a corresponding exponential increase in overhead management.
Now, to acquire these capital-intensive commercial assets, investors frequently execute an equity rollover.
Yes. If an investor holds an asset that has experienced significant appreciation, trapping millions of dollars in unrealized equity, selling that asset outright triggers a substantial capital gains tax liability.
Which severely diminishes their purchasing power.
Exactly. Tait explains how to circumvent that capital erosion. The investor can utilize a cash-out refinance to extract the equity completely tax-free.
Because loan proceeds are not recognized as taxable income by revenue authorities.
Precisely. Alternatively, in the United States, they can execute a Section 1031 exchange.
Selling the relinquished property and rolling the entirety of the proceeds into a larger replacement property, legally deferring all capital gains taxes.
It is a phenomenal tool for wealth accumulation. It is the real estate equivalent of the classic monopoly strategy, leveraging the equity from four greenhouses to acquire a red hotel, utilizing the tax code and the bank's capital to fund the transition.
His writing reflects on this with a detailed corporate case study of an investor named Sophia.
Yes. Sophia utilized these exact mechanics to transition into a 100-unit apartment complex valued at $8 million.
She syndicated $2.5 million in equity from limited partners and secured a senior commercial loan for the remainder.
The critical element of Sophia's case study is not just the acquisition, but the subsequent value-add strategy.
Right, because commercial real estate valuation is not primarily determined by comparable sales in the neighborhood.
No, it is calculated by dividing the net operating income, or NOI, by the market capitalization rate. Sophia initiated capital improvements and optimized operational efficiencies, thereby increasing the property's NOI by 40%.
Because of that mathematical relationship, a 40% increase in net operating income forced a corresponding exponential appreciation in the asset's total valuation.
Exactly. Pushing the $8 million property to an $11 million valuation. She manufactured $3 million in institutional wealth purely through operational optimization.
And as Tate points out, as you scale utilizing these methods, geographic and asset class diversification becomes the primary risk mitigation strategy.
By distributing capital across multifamily, industrial, and triple net retail assets in varying economic zones, the sponsor insulates the broader portfolio against isolated, sector-specific downturns.
We have conducted a thorough executive review of the material today. We have detailed the mathematics of leverage and the fulcrum of equity and debt.
We also examined the sophisticated structures of the alternative capital stack, including the collateralization of mezzanine debt and the regulatory hurdles of tokenization.
We dissected the underwriting requirements of a pro forma and the absolute necessity of transparent crisis management during capital calls.
And finally, we explored the tax-advantaged mechanics of scaling through 1031 exchanges, equity rollovers, and NNN lease structures.
The comprehensive takeaway from Tate's methodologies is that real estate investment at an institutional level requires a dual competency.
The sponsor must master the quantitative financial engineering required to underwrite an asset, while simultaneously mastering the qualitative corporate governance required to aggregate capital and manage investor relations.
One simply cannot function without the other. Which brings us to a final macroeconomic consideration for you, our listener, to evaluate.
It is a critical point to ponder.
As the financial mechanisms for capital aggregation, such as syndication platforms and equity rollovers, become increasingly streamlined and democratized, we are witnessing the rapid institutionalization of real estate.
Yes, the barriers to entry for large-scale capital are lowering.
If a well-structured syndicate can continuously roll over tax-deferred equity to aggressively acquire vast portfolios of property, one must question the long-term impact on the broader market.
It changes the entire landscape.
Will the traditional concept of the independent individual property owner eventually be priced out of the market entirely, replaced by massive, fractionalized portfolios managed by institutional sponsors?
It is a structural shift in the global housing and commercial markets that warrants deep, ongoing analysis. It is a fundamental transformation of the asset class.
As we conclude this masterclass, a brief reminder to secure your copy of the book. Willem Tait's Raising Money for Real Estate Investment is available worldwide via major retailers, including Amazon, Apple Books, Walmart, Barnes & Noble, Bull.com, Waterstones, and Exclusive Books.
Furthermore, please take a moment today to email your local librarian to request the title be added to digital lending applications like Overdrive, Libby, Hoopla, or Odilo for free community access.
Finally, ensure you check the links in the show notes to connect with Willem directly for professional advisory services and follow this podcast feed closely.
We look forward to many more analytical sessions hereafter on his wider publication portfolio.